Welcome to our CFP exam prep discussion on yield curve theories. Today, we're diving deep into a crucial topic that frequently appears on the exam and often confuses candidates. Understanding yield curve shapes and their underlying theories is essential for success on the CFP exam. Let's start with the fundamental concept of a yield curve, which shows the relationship between interest rates and time to maturity. The three main theories explaining yield curve shapes are liquidity preference, market segmentation, and interest rate expectations. The liquidity preference theory tells us that investors naturally demand higher yields for longer-term securities. This makes perfect sense because locking up money for a longer period means taking on more risk. The theory suggests that investors need to be compensated with a liquidity premium. Think of it like this. If you're lending money to a friend, you'd probably want a higher interest rate if they're borrowing for 10 years versus just 1 year. This concept helps explain why normal yield curves are upward sloping. Moving on to market segmentation theory, this approach suggests that different investors operate in specific segments of the yield curve based on their needs and preferences. Insurance companies typically focus on long-term bonds to match their long-term liabilities. Banks often prefer shorter-term securities for their liquidity needs. The demand and supply within each segment primarily determine yields, with limited movement between segments. This theory helps explain why we sometimes see unusual kinks or shapes in the yield curve. The expectations theory is particularly important for the exam. It states that long-term rates are essentially an average of expected future short-term rates. When investors expect future short-term rates to rise, the yield curve tends to be upward sloping. Conversely, if they expect rates to fall, the curve might become inverted. This theory helps explain why yield curves can predict economic conditions. A common mistake students make on the exam is confusing the causes of different yield curve shapes. Remember that an inverted yield curve, where short-term rates are higher than long-term rates, typically signals an expected economic downturn. This isn't just about the expectations theory. It's often a combination of all three theories at work. Another frequent error is failing to recognize that these theories aren't mutually exclusive. They work together to explain yield curve behavior. The exam might present a scenario where you need to apply multiple theories to fully explain a yield curve shape. Here's a practical example that often appears on the exam. If you see a steep, upward sloping yield curve, don't just attribute it to liquidity preference. Consider that it might also reflect expectations of rising rates and limited demand in certain market segments. The exam loves to test your ability to synthesize these concepts. To solidify your understanding, think about the current yield curve shape and try to explain it using all three theories. This exercise will help you approach exam questions more confidently. Remember that yield curve analysis questions often appear in both the investment and economic sections of the CFP exam. They might ask you to explain why a particular yield curve shape exists or predict economic conditions based on the curve's shape. The key takeaway is that understanding these three theories and how they interact is crucial for success on the CFP exam. Focus on recognizing how each theory contributes to yield curve shapes and practice applying multiple theories to explain real-world scenarios.